Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update. I'm actually doing this on the 20th. I did the deck last night, so I apologize for the date. Market's down third week in a row. My email address is hgsidoc@gmail.com. Let me apologize in advance for the audio. I'm having difficulty with my setup in Santa Fe, and I just got here and I'll work on it during the week to get it fixed. Plus, I think I picked up a little cold. This is for educational purposes only. Anything I recommend should be in the sphere of education, not investment advice. I'm a doctor, not a broker. I am independent. I am not affiliated with any software vendor or trading company. I demonstrate the tools that I use every day in my trading, and trading involves risk, and you're solely responsible for any investment decisions you make. Like many folks, I use lots of different platforms, TradeStation, TradingView, but the one that I use the most these days and for quite some time now is Wealthcharts for my nightly and weekend reviews. My indicators that are specific to me and some of the scanners are now available in TradeStation and TradingView. Please contact me if you have any questions about that or would like to see some examples. I do post videos most mornings at stocksanddocs.com. And these, unlike the video that I'm doing right now, which will probably be 40 minutes or less because of the market conditions, these are usually 5 to 10 minutes. Major markets tell the story. I think we can see here that the only thing over the last 5 days that was green was the dollar. And interestingly, silver, although gold was down over that period of time, silver had fallen faster and further than gold, so potentially it got to bounce area. You'll notice the yellow are the major indices, and on Friday, NASDAQ was down a teeny bit. The others were up. The most was the Russell, which lost significant on the week compared to the others, was up 0.5. If you look at your current interval from the 52-week high, you could see that the major indices are close to their 52-week highs. And the one that really fell the most was Bitcoin, down 12% on the week. Now, over here, we see how far we've come from the October 13th lows, and we can see that the IWM has given up significant in the last week. It was above 20%, as was the NYSE. All the sectors were down on the week, a week that was, for the most part, a challenging week in the U.S. stock markets. Here are some of my views of market breadth. This here on the right shows me that on Friday, 91% of the sectors were up, 69% of the industries were up, and stocks 61% were up. You could see here the only down industry group or sector rather was communication. And you can notice that you still have most of the stocks bunched up in the lower half of their Bollinger Bands, and you still have about 10% below. Now, Friday was interesting. The market started a little bit lower, and we'll look at that. And then I watched the dashboard here, and where it came really helpful is we initially ran up to 25, 28% of stocks below the bottom of the Bollinger Band, which in itself tells me to start looking to nibble long if it stays there. And then all of a sudden, these things turn green. So even though the major indices were down, the broader markets actually were stronger on Friday. Now, of course, 82% of the stocks are below the midline of their Bollinger Bands. Is not strong by any means if you look out more than just Friday. So here is Friday. Some of it's green, as we talked about. Actually, here is Friday. Here is the last 2 days. But over 5 days, you could see all the sectors were down, 96% of the industries and 87% of the stocks. So it was a tough, tough week. And even over the last month, it's been a tough week for the bulls, or tough month for the bulls. Here's Nick Drendel's worksheet. This is up on one of my computers. It's like $45 or $49. It's such a great little tool. What I want to show you is that unlike most of the days of the week, we close at the upper part of the closing range. So that's actually, to me, a little bit optimistic and positive versus closing at the lower part of the range. But look, all the major indices are below their 50s. That's never good. If you look at the market breadth and look at whether you're looking at indexes, S&P sectors, the only S&P sector that is above its 20 and above its 50 is energy. Wow. And if you look at industry performance, you could see a lot of green, small numbers, retail up at the top uh, on the 1 day. But for the week, the only thing that was green was metal and mining. Now, this is not inclusive of all industry groups, but it does represent a lot of the industry groups that we might look at as a growth stock investor. And then down here, look at over the last month of how the new lows have have taken over the new highs. Here's my weekly timing system. It's actually a slide from TradingView. And notice that although the price closed on all of them, including the Russell, which is close above the 30 period WMA, which is one of the two requirements I have to say buy the market. The second one, the weekly bongo, has turned red on three of the four, on the Spider, the Qs, and the Russell. So the only one holding a buy signal, and not one that I would have lots of conviction on right now, is um, the Dow Jones Industrials. So none of them are in an avert sell. To be in an avert sell, you'd have to be both below the moving average and a red bongo. But it is clearly at the minimum a yield sign flashing. And to me, it's be careful time. Not necessarily short the market, but be careful. Rising rates impact the markets. You know all this. You could see on the week, um, the 10-year was up, looks like 2%. Wow. The 30-year also up 2.5%. And you could see the 10-year and the 30-year almost going straight up. This is reminiscent somewhat of back here when the markets could not handle the rapid raise in rates and they started to fall back in the beginning of 2022. Rising rates at this point are probably not good for any equity class. And clearly, when I looked at some of the top stocks in the markets, I didn't walk away thinking about banks, regional banks, and insurers. So I think the markets will remain pressured until we see the rates come down, or at least the data start to support them coming down. The recession in our near future, yeah, I'm a broken record. I mean, if you look at the 210 inversions, the 310 inversions, or 10-3, 10-2, whatever way you want to call it, every time we've inverted below this line, you've gotten a gray bar. The gray bar doesn't occur until the yield curve uninverts. What would make the yield curve uninvert is rapid reducing of interest rates by the Fed, probably because of economic weakness. So I think the top two say, yep, a recession's probably coming. And again, as I joked on one of my videos last week, a recession is always coming, whether it's tomorrow, in 3 years, 10 years, 20 years, you're guaranteed to see recessions. Look at the map here. From 1990, 1, 2, 3, 4, 5, 6 recessions. So, of course, we have a recession in our future, but probably not tomorrow. Credit risk, this might be another tip off of danger. When you look at the big recessions, you see the peaks. You don't see a peak here. And then the one that is confusing me is the Philadelphia um, Diffusion Index, which is a measure of economic activity, because it's now crossed back above zero. And I couldn't find any other period of time where the recession occurred after the economy improved. So for those that are soft landing fans or no landing fans, that's got to give you some happiness. Breadth worsens, but not extreme. Stocks above the 40 in white, stocks above the above the 200 up here, stocks above the 40 down here, and the 13-week new high, new low. They've all come off their highs significantly, but we have a fair amount of way to go before the word extreme comes in. Now, when this T2121 comes down to about less than a half of a percent of new highs versus new lows, markets reverse. We're not there yet. The buckets, similar to what I showed you in the Q Edge tool, most of the stocks in the S&P 1500 are below their midline of their Bollinger Bands, and about 10% are below their bands. It can get much worse, so that's not extreme. The Hindenburg Omen fires at times of market entropy at tops when the pros are getting out and us amateurs are buying their shares. It's had a few fires in the NASDAQ, especially as we topped here. But the part that I think is most impressive is looking at the new lows, and even the fact that the new lows are starting to creep up on the NYSE, which has been resilient. So more reasons to be concerned that this market has deteriorated. And then this is an edge rater warehouse view where I take the fundamentals, especially EPS rank, relative strength rank, and group rank from last Friday, and I run it forward and look at how it impacted on performance. First thing, everything here is below zero, which means the market was down decidedly. Your earnings per share rank, you were less down if you had earnings than if you didn't. Yet your high relative strength stocks continued to be punished. Um, Not a good week in the market. Know your news and earnings. It's a middle week. It would be less if it wasn't for the fact that Powell was giving interviews in his speech at Jackson Hole. It'll be very interesting to see what the Fed has to say about the future of rates. Will he talk down rates in September and give the market a reason to pause this decline? Or will he try and talk down inflation? And then for earnings, you can see a lot of retail earnings coming up this week. And it says here it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. So, market sold off lighter volume this week. End of summer doldrums. Wouldn't be surprised to see that in the beginning of the week as well. Support has broken. Only the diamond remains in a buy signal by my timing model. Treasuries probably drove this down. We talked about the rising rates. The FOMC minutes whipsawed the market when they first came out. China economic weakness hurt Chinese stocks and led them to actually start to drop some rates and to support the yuan. I don't think we're done with this pullback. We're probably going to see a bounce soon, but I would not assume we immediately resume the uptrend. So again, I reduced my positions, raised some cash, prepared to play the market, whether it moves up or down. But if I have to have a bias, I'll put my bias to the downside. On to the charts. All right. So we're going to start with the 5 minute look of the spider. And you could see at the open on Friday, the market gap down and then steadily rose the rest of the day, finishing right about where it opened, up a little bit from the prior close, not from where it opened, but from where it closed the prior day, up from the open for sure. If we look at the daily charts, you could see a green candle, so it closed higher than it opened. You see a little bit of a tail on the top, nothing on the bottom. And it's interesting, when we were above the 50, my expectation was a bounce, a retest, and go higher. Well, we failed the retest. And now my expectation is we're going to retrace into that 50. And it'll be interesting to see if we can break through or do we bounce and go to lower lows. That's my guess is that we're going to go further lower here, but that's a guess. The MACD is currently getting more negative as we sit here. Look across the major indices, you'll see similar patterns. So the spider was up a teeny bit. The Qs rather have the same pattern, broke through the 50, and they were down 0.13. If you look at the diamonds, they're the ones that are holding up here, holding up on their 50, and they were up 0.03. Russell knifed through but closed above their 200. We'll see if it doesn't bounce around like it did back here between the 200 and the anchored VWAP. The VIX on Friday ran into that 200, which one might assume is going to be a little bit of resistance here, and reversed. Sorry about that. And then you can see the dollar, which has been a concern of mine, has broken above this area that I thought might be a little bit of resistance going back here to 2023. The dollar is worrisome here. If it doesn't drop below this level, one might expect much higher levels on the dollar, and I don't see how that's good for equity markets. Commodities, I probably have to look to my broker here. With the dollar strength, you'd expect gold and silver to be weak. Gold and silver both bounced a little bit on Friday, but they're way off their highs. Oil, we talked about it, was putting in a flag, potentially a bullish break above that, the highs of the flag on Friday. We'll see if that can hold up. And natural gas will continue to say is dead to me. The 10-year got into the danger zone as well, a zone that if it doesn't hold, I'm worried. Like the dollar, I'd be worried about this market. I think we're at levels now not seen since 2007. If we break above this, um, and one can see that this has been an important level in the past. So we actually came down a tad on Friday, but if I throw the weekly on, you could see we're right up there. So I think the two tails that I'm going to be watching besides the indexes is going to be the dollar and the 10-year. Again, the weekly market signals, you'll see the same pattern. The IWM holding right above the 30 period moving average. All of them except for the diamonds have dropped on the bongo. So the IWM is close to going into a sell, but it's not there yet. I would put yield, so I have to change that. There is a yield sign in here. I don't want to spend that much time looking for it, but there is a yield sign. I'll put that on later so I don't forget. So ignore the green arrows because this market has now gone to neutral for the spiders, the Qs, and the Russell, and barely hanging on for the diamonds. If we look at the breadth indices in the market, so one thing we're going to look for if we think we have a recession is going to see a spike in the ratio of the TLT to the spiders, no spike. If we look at general stocks, the RSP, the equal weighted spiders versus cap weighted, starting to be more neutral. Same with the Qs, equal weighted Qs versus the cap weighted. Um, this is the Qs versus the Russell. The Russell's had a little bit of outperformance, still very much favoring the Qs. And this here is looking at the 50 if it points up here, the fangs if it points down here. And even with the fang weakness, they're still way outperforming the 50. Go into the scanners, and we'll start with Well Scanner. And, I'm going to look for a couple of things, three things. Well, more than three. I'm going to look at the order and what's up there. The flame says there's a lot of movement in it, and that recent movement. So that's important to me. The arrow is important. That tells me it's getting stronger, though I don't really want to see the dollar stronger. Short the bonds got weaker. Pharma, which was leading, got a lot weaker. But the other thing that stands out here and slaps me is that there's nothing above 800. There's only two things above 700. That just gives you a sense of the overall weakness of the market. So if I had to go long, I'd be looking at energy. XOP, XLE are at the top. Now, home construction, which has been a leader, has really come down. Now, does that mean it's done and it's not going to go up? No. But I think rates are even bothering that. And seeing SARC here, this has been one of my positions I'm holding, which is negative the ARC. And I mentioned on one of my midweek videos, I actually went in and looked at the components of the ARC. And to say they're ugly would be an understatement. The ARC components look horrible. Um, but if the ARC is bad, that means SARC is good. SARC is short the ARC. So do you see things here that really make you want to go out and buy? I don't. So the only thing that looks interesting is energy, and a lot of stocks look just like this, although a lot of them are below their 200. A run up and a pullback to support. And this one had volume and breakout on Friday. So look at relative strength in OBV. So XOP energy might be a place to look. Now, if we wanted to flip this to bearish and see what's really not working, let's flip the score. Real estate, high rates, and then the concern about all those offices that people don't want to go back to work. And I'm a business guy. I have worldwide about 3,500 employees. Some of my offices, you have to be in the office to work. Most you don't. And every time we try and tell our employees, you need to come back into the office, there's a rebellion. Now, as employment goes up, the rebellion's going to quiet. So I sit on prime real estate on the water in Palm Beach, and I have 5 people of an office that will hold 300. How is that sustainable? And you look around, this is just the story of today. I go and visit big pharma companies, biotech companies, healthcare technology companies who have billions of dollars of investment in real estate, and there's nobody there. I think the commercial real estate is going to be interesting. Maybe they can convert them to cheap housing. But real estate, global real estate, the IBD 50, small cap growth lagging, um, REITs, solar, ARKK, this is why I'm long the SARK, and then biotech. Now, this will only go up in the 500s. And look at how many are in the 500s here versus when I flip to the bullish, how few are, or how none, frankly, are above 800. All right, so if we go and we look at just for the heat map for grins, we see a fair amount of green. And as I mentioned in the beginning, even though the indexes started off the day sluggish, very quickly the overall breadth in the market improved. So just telling me the markets were much stronger than I first may have thought based upon the indexes. So let's go into the CAT scanner. So I mentioned energy. So let's look at energy and see if there's anything that looks interesting. Now, I go through 1,000 stocks on the weekend. I'm a little late this week because I flew out west yesterday, and I prefer to do it at my desk with multiple monitors than on a computer. And a lot of the stocks that I picked for potential buys were energy stocks. I'll also tell you that the number of stocks that pass my screens that I'm going to be watching was very small compared to a typical week in a good market. So, Canadian Natural Resources. Remember I told you the pattern? There's your pattern. Nice uptrend, pull back, and look at this. Volume, breakout momentum from a squeeze, relative strength, and OBV look good. This is not unusual looking in some of the oil patch stocks. ESTE, this is another smaller oil play. And again, the same pattern pullback. Now, these are both in uptrends. They're above their moving averages, 3 dots, volume, relative strength, and OBV. These are two that I liked. PAA is an MLP. So an MLP, there's that same chart as XOP. An MLP, now notice it has an EMS signal. Stock opened down, and that's probably when the EMS pops. So that would keep me a little weary. But notice big uptrend, volume, breakout momentum, relative strength and OBV, and this pays a dividend. And then another one that I've been in that I probably need to think about getting out is CEIX. And you could see where it took out the flag when I got into it. This had a little bit of a move of late. And actually, this is the flag I took out. So it's had a couple of flags and breakouts. This is a coal provider, and it still blows my mind in 2023 that coal stocks are doing well. Um, I guess it's because of, quote, clean coal. And here's another MLP. This one pays another big dividend. So not always great looking chart patterns. So if I go back and I look at all stocks, I know I'll look at my combo buys, which are, I'll put this in the YouTube list, the list of stocks. These are from a lot of different sources that I combine to get the 1,000 stocks that I'm going to look at over the market. Bloomin' Brands, I believe this is a restaurant stock. There was some strength in restaurants. Now, I'm not a technical guy, excuse me, a fundamental guy. How did I say I'm not a technical guy? I am not a fundamental guy, but I have to wonder the strength in retail, the strength in restaurants, the strength in travel, will that be able to get through the repayment of student loans that starts very soon? I don't know. But right now, this has done well. Ross stores looked really interesting. Now, My first thought was, oh no, it's probably extended. It's not. This is why I have the high-low jump. At 31%, it's not extended. I don't like the reversal here, but boy, look at the big move up and probably on earnings the day before with a 13.7% beat. This is a stock that has been a leader for a long time in retail. I think it's probably one of these off price. You could see the run it had here, way off the highs. Um, I don't think my wife shops there, but not a bad looking chart. A lot of love the volume, and you can see all kinds of upgrades. So 130, 135, 135, 132, 131, raises to 84. You're a little bit behind. 127, 140. So a lot of upgrades came out after earnings beat. So this is, I think, a discount retailer, and one might do better in the setting of tightening um, pocketbooks from paying back student loans. Abercrombie and Fitch, this is another one. I think of this as more of a teenage um, and young adult. Nice uptrend, beautiful candle here after a little bit of a pullback, great volume. Volume breakout momentum, relative strength and OBV look good. Here's that CNQ and ESTE. Globant, it made the list because it had the dots in the volume. And maybe there's something good here. I just don't like it's too much congestion. It's not in an uptrend. Agro, don't know anything about this stock, had a big reversal on Friday on good volume, breakout momentum, relative strength was good. OBV is not there yet, but that might be one to watch. So there are stocks here. EQT, I remember I did a Wealthcharts program back in here, and somebody was talking about how they thought natural gas and EQT. Well, EQT did not move right away when we talked about it. It may have been down here, but it's been in a really nice run since that was pointed out. And it did have breakout momentum, relative strength, and OBV look good. I can't remember what that line was from. Oh, must be a reason for that line, but for the life of me, I don't remember what it was for. So those are some of the things. I don't want this to sound like a bull time because it's not. I have let's look at the plenty of stocks that are pulling back and are retracing and breaking down. I mentioned China weakness. I don't think I would be playing with this thing. It's too gappy. But John Deere, what a great company, great American story, doing very well. Um, Probably benefits from the infrastructure play. You don't like to see this a breakdown below the 200. Maybe it bounces and tests, but I think that looks like something that I'll be watching on the short list. You can see relative strength and OBV have dropped down. Allstate in insurance has already come down a lot. So let me pull some of the stocks that I thought looked interesting on the long and the short. Because I'll be honest, there's no reason for me to go really long on the longs here because I think you got to be careful, and I don't want to come off as thinking that it's a buy market because to me it's not. So these are some of the ones that I looked at as potential shorts. Um, CME Group has been on a tear. CME Group broke below the 17, had an EMS. Would I short it yet? Nope. Am I be watching it every day because a breakdown here could run all the way down to the 50? Yes, I am going to be watching it. Here's John Deere. We just talked about it. FedEx, great American company, broke down. Again, it's tough to short things off the high. So I call this really a short screen because if these things continue to break down, that's going to tell me problems are in the market. Netflix, again, this one, water's coming through the hose and destination is probably 352. Do I think it's going to go there? I hope not. It could bounce here, but I'm going to watch it. Um, WMS probably bounces off the 50, so it's probably too late to short. But I put a list of stocks that I thought looked weak, and if this market rolls over, will probably give me some nice retracement setups. On the buy side, as I said, It'll look like a lot, but it's really not compared because all this does, it gets put into my radar screens and I watch them closely. Um, CELH is probably the stock in the market right now. It's just off its highs. It just keeps going and going. And for so long, they talked about great earnings because of a Pepsi distribution. Well, the earnings are here. And that's probably a big point of why it's done so well. Um, Helix was an energy service company that looks to me like it's ready to potentially roll and look for some more momentum. I call this a pullback waiting for signal. Lilly remains another super strong in the market, mostly driven by its diabetes pills. I told you first, and now all they talk about on CNBC and the news is who's paying for them. That doesn't surprise me at all. Seadrill is a driller. Diamond is another one. Look at the beautiful move here, sideways consolidation, and a big move on Friday. DO was another. So there are stocks that look interesting to the long side and short side. The markets, do we bounce here and get a couple days to the upside and then roll over? Perhaps, and maybe they'll use Jackson Hole as that reason. I think you got to be careful in the markets right now. I think that I'm not saying short the market. I'm not saying go all buy contras. I'm not saying the world is over. I'm saying that what we just experienced, which was a beautiful run up, has taken a pause. And we don't know if that pause is to refresh and we go higher or that pause is beginning of another downtrend. Um, we'll get our opportunity to go long in the future. Have a great week. Sorry for the audio.